We do an eightfold advanced goal is going to be $9,000. Okay. Because we started from 1,050. And that merely replicates the dimension of the prior two big bull markets in the last 50 years. But if you look at the action in the last year, or even the last several quarters of each of those bull surges, the one that peaked in 1980, $850 gold, silver is $50. Or look at the one in 2011. Much of the percent gain occurred in the final year, or actually in the final several quarters. And it's at that point silver went berserk in relation to gold. We've got reasons to believe, and this is not gut level or just looking back at the past. There's technical reasons when we assess the performance trend of miners versus gold and the performance trend of silver versus gold and plot it technically as a spread, and then run momentum studies of it. It says to us that the pullback we saw in performance since that surge in mid-2020, when silver and the miners beat gold handily during that big boom, But in the years since, they've retreated on a relative basis. Silver's more or less gone sideways, actually. It has not lost ground to gold, but it hasn't outperformed. And the miners have actually lost performance. Those charts tell us that we're in the upturn phase now, out of that period where those categories of the monetary metals underperform gold. They're now about to shift to outperform. So it's a technical assessment. And I think that's will be coincident with an acceleration in price of the entire complex.
Got it. So I want to go back to the miners, but real quick with silver here. You gave me a projection on gold. Correct me if I'm wrong. You said we're looking at about 8-9 grand on the upside.
That's not a target. It's not a target. It's just simply stating prior to realities. And you, as an investor, can decide whether he thinks the reality today is similar to those, or is it far more dramatic? And I think it's going to be more dramatic in terms, not just here in the U.S., but globally, in terms of especially government debt crisis. Right now, we're watching commercial real estate for a debt crisis, not mortgages, but commercial real estate, and hence, therefore, the financial sector. I know everybody's looking at NVIDIA like that's the be all and end all. And no, it's not. Look elsewhere. But when that stuff hits the fan, the panic mode and the emotion involved in markets will shift dramatically. And I think it's already beginning to where you'll see miners do things on the upside that are just jaw dropping in terms of gain and speed of gain.
That's music to my ears, but I want to go back to the miners just a bit. But what's the same kind of historical data that you see with silver on the upside?
Silver has twice been to 50, and of course, gold's above those comparable levels. The 1980 peak, the 2011 peak. So what's wrong with silver? Okay. I think this advance is going to blow $50 out. It's really an idiot price level because it's two different times of the last 50 years. Conditions were totally different, fundamentally, and so forth. And technically even. And I think that the $50 level is sort of a level for idiots to say, oh my gosh, I better wake up. Well, you should have woken up a couple of years ago. But anyway, I don't think 50 is resistance. I don't think it's a target. I think you blow it right out. And maybe you take a breather somewhere $10 above there or something. But ultimately, the silver gold ratio that we measured by dividing an ounce of silver into an ounce of gold, expressing it as a percent. Right now, it's at 1.15%. Divide silver ounce into gold ounce using the front month active contracts. In 21 of the past 50 years, meaning not even during bull trend times, silver's been 2% of the price of gold. Well, right now it's 1.15, almost a double just to get to a normal level that it's seen 21 of the past 50 years. So it's not even saying, oh, you got to go through the roof. And in the bull trend periods, like 79 to 80 and 2010 to 11, when silver accelerated, it got up to 6.5% of the price of gold in the 1980 period and got up to over 3% of the price of gold in that 2011 period. So if we go from 1.1 to 3, for example, still below the 2011 high, of the spread relationship and way below the 1980 high, that means silver could triple from its current relative value to gold. Okay, well let's be silly here. Gold goes to 8,000. You do the math. What's 3% of 8,000? Okay. Okay. Yeah. Okay.
240?
Yeah. You got it. And I mean, so, we're $35. Okay. So don't laugh because,
I'm not laughing at
no,
you. I'm
it's so
not
I'm just
laughing at you.
saying that the no, even if it went just to 2% of the
I'm
price,
happy, Michael. I'm
Yeah.
happy.
but it's not going to give you stop and go. I don't think you can get this, oh, we're going to pause for 6 months or, oh, we're going to correct for 15%. I think there's a point here, and I think
Yep.
we're at it, where you're not on board. You could miss it.
Yeah. Okay, so that leads me to another question. And by the way, I don't. I'm not laughing at you because I think you're funny. I'm laughing at you because I think
I
you're
understand.
correct. But whoa. But and then for all my viewers and listeners out there, Michael's been right a lot. I'm a client of Michael's, and I have nothing but good things to say about Michael. But let's go back to trading in and out, or just catching it, or we might get left at the station. So I've been up a lot since January in my gold and silver stock positions. I did sell a quarter of it, and I was up to my eyeballs. Did well, sold a quarter of it. I'm just waiting for a pullback. But would you recommend something? Well, recommend's a strong word, but is that something you would do, or do you just stay fully
No,
invested?
I think you've had the pullback.
That's
And I
I
think at
choose
this
not
point,
to
I
wanna
would
look
look at, I would, this is my own personal positions. Okay. There in our reports at the end, there's a disclaimer that states, what we own. Okay. My emphasis is the gold and silver miners, either via GDX, the basket,
Yeah.
double GTX, and silver miners, specific ones.
So,
I've got a handful of them, and I'm going to expand it. So at this point, at this juncture where I think we're about to accelerate, my emphasis is not to be fully invested, because I am, but to shift the investment around and lessen my straight bullion position in gold and move it over more to a silver bullion or a double silver bullion position, and or into the silver miners, because I think the geometry there could be jaw dropping in the
lot more
miners,
torque. Yeah.
because historically they are so beat up historically compared to the price of gold. Like XAU index is an example. It's been around since the 1980s.
Mhm.
It used to trade as a relative percent of the price of gold in a range where you divide XAU price into gold price, in a range from the 1980s, 1990s through 2008. Okay, so 20, 30 years, in a range that had low end 17.5% and an upper end at 35%. So let's call the middle, let's say 25%. So XAU would do this over that 30-year period, but generally around 25% of the price of gold. It collapsed to 4% of the price of gold during the 2015 bear low, when it bottomed coincident with gold in net price. Right now, it's about 5.5%, a little higher probably. It's been in a 10-year wide range on the spread, not up there in the 17 to 30% level, but in the 4% low, and basically 5 to 8% doing this for 10 years, meaning holding its value versus gold, but at extremely low relative levels, historically speaking. If you look at that chart, and we've sent it out in our reports, and look at the bottom end of that 30-year period, where it was 17.5 to 35%, and draw a line through all those lows that prevailed for several decades. That means you break this spread out, technically speaking, you could run up and bump your head on the bottom side of that multi-decade range, which is technical resistance, right? Okay, boom, the bottom of the old, what had been a floor. And you could stop there if you want. That's a tripling plus of the current value of the miners relative to gold. And we're seeing emergent breakout now, this month, on
This
the
month.
that suggests we're coming out of this base, of this performance base, which is again very subdued. The top end is only 8%. And 17.5 used to be the bottom end. So, decades ago. So we could get an extreme explosion out of the gold and silver miners. And the reason being coincident with the breakage in the stock market. A lot of investors don't want to go out and buy silver bullion or futures or things like that, or buy leverage call positions. They just want to buy miners.